Yeah, see, so the markets remain in sort of a price discovery mode. And, it's unknowable whether the low was last Friday, that intraday low at 28.50 or so, or whether it's lower. I mean, these are just unknowable things because it's obviously such a fast-moving development. But I do think Friday we got to an oversold point, and the rally to sort of 3,100 was, I think, fairly predictable. That's a typical retracement. And then we filled there. I didn't want to read too much into yesterday's lack of a response on the Fed's 50 basis point cut, because the markets are just too chaotic to draw that linear a line to. So we're kind of discovering where we are, and it's a question of how deep and how long is this supply shock and coincident demand shock, and to what degree will the policy response be able to build sort of a bridge to the other side in terms of trying to offset the tightening of financial conditions that obviously is happening right now. So who knows? But I think we had that big impulse down. We had the sharp retracement with Monday's rally, and now we back and fill. And we could back and fill for a couple of months, actually.
Right. You did say this could be a process that take months. I want to get to Steve on some fundamental analysis, but really quick, Jurrien, Ray Dalio's point this morning is that the markets, as a result of all this volatility, are going to have players who are squeezed by cash flow issues rather than making fundamental decisions. How much of a danger is that?
Well, I mean, we saw that on Friday, right? I mean, gold was down, what was it, like 60, 70 bucks. A safe haven turned into a source of liquidity, just like it did in '08. And I don't want to draw too many parallels to '08 because I think we're in a totally different environment. But the margin players who get margin calls or collateral calls, they end up having to sell what they can and not necessarily what they want. So I think Friday we saw a strong whiff of that. The stocks that you would think should have done well didn't. So maybe there's other waves of that coming, but I think Friday we actually saw that kind of crescendo of selling, and that gives me some hope that maybe that worst impulse is behind us. But you never know. When markets run as long as they do, you never know where the hidden pockets of leverage are, where once the margin calls start, the whole thing becomes a cascade. But I think I'm heartened by the fact that on Friday we saw a lot of that already.
All right, Steve, let's talk about how you assemble shopping lists, given everything Jurrien just said.
Well, as he pointed out, we were set up for a bounce because tech got quite oversold. The RSI was under 30 on our tech index. It was very close to its 200-day moving average. The question is, where do we go from here? The coronavirus is somewhat encouraging in China. Foxconn's talking about getting up and running by the end of March. Tim Cook at Apple sounds fairly positive. At the same time, we've got semiconductor and computer companies really cutting back here, about 5% on earnings typically. And I think we may have some more to go. So we're still underweight hardware and semis, overweight services and software. We did put together a little shopping list based on companies, stocks whose oversold, have good return on capital, near the 200-day moving average, have reasonably good earnings momentum. So names like Accenture, Western Union, Booking, Match, Cognex, Amphenol. But it's going to take time to play out here. And I'd point out that tech has been very narrow. Our index is equal weighted, and it's been a market performer the last year. It's really been those big platform companies like Apple, Microsoft, Google that have outperformed. 9 of the top 10 market caps in tech are platform names, and we would still feel comfortable owning those.